And just to get one thing clear right up front, I did not cause the Asian crisis that started in Thailand. I was in Indonesia at the time. Um, this is my third conference here, so over the many years, and I was asked to talk about the U.S. economy. I take a different view than Tom. We are, economists, as I've been a forecaster for about 25 years, and I learned from the best forecasters that economists are always wrong but never in doubt, so keep that in mind as I'm talking to you. But I take a different view from Tom on the U.S. consumer and the U.S. economy, in that I think if you look at averages, the U.S. Consumer, the U.S. economy looks in fairly desperate shape. But if you look at the real setup and income distribution of the United States, I would suggest that you're going to see the U.S. economy perform above expectations, and we've held that view for the last 6 months, and the market is coming our way, at least for the time being. And that the U.S. consumer, while he will not grow faster than overall GDP at 3.5% this year or next year, he is going to grow at about 3%. It's a couple of different items we want to look at in coming to this conclusion, and that is some of the flow information, that's income, employment, disposable income, and then we want to look at the stock information, and by that I mean the wealth that is the wealth of the households that is in process of recovering and really creates your ups and downs in the U.S. consumption patterns. And then we want to look at the distribution of income, because that matters a lot here and the way we move forward. But for the next year or two, I feel fairly good about the U.S. outlook. Now, why are we talking about this? Because clearly we've got a world that needs rebalancing. What you have on the on the screen there is essentially the current accounts of the fourth quarter of 2008 and the fourth quarter of 2009. What you can see is the imbalances are closing. The reason we're talking about the U.S. consumer, somebody has to finance that. The financing needs of the U.S. have gone down over the last year, but those have bottomed now, and as they begin to expand again, as the U.S. expands, I would expect the trade deficit to pick up again. If the world is not willing to finance the U.S. trade deficit, then that's going to create an abrupt stop to the recovery, but I don't think that's going to be the case as people look at the U.S. and put money back in there, particularly with the impact on with the recent events in Europe, and also the fact that Asia needs to finance the U.S. Whether we like it or not, we have an umbilical cord to each other, and I doubt that anyone's going to pull the plug on that situation. Now, let's just run through some of the data points. The next five charts are from the U.S. or from the U.S. Federal Reserve Bank of St. Louis, and what they do is they're just setting up what have been the best we've had coming out of crisis, what's been the worst path we've had for the consumer, what's the average, and where are we in this one. And you can see that essentially they've been very, very much worried about the naysayers, that this is a very, very weak recovery in the labor sector. When we look at payrolls, that blue line is the lowest ever. It's setting the new minimum. But in the last 2 months, what have we seen? We've seen the U.S. Payrolls rise by 230,000 in March and 290,000 in April, and those trends seem to be in place, and I would expect to remain around 150,000 a month outside of the census moving forward here. So we're beginning to pick up after a long and slow downturn. Also, real disposable income, that hasn't taken as much a hit due to the tax cuts. Remember, the current is the dark blue line. The little spike there is the tax cut, the fiscal stimulus. That's washing through, and that does become a risk as we move into 2011 if the Obama administration does not roll those tax tax reductions forward, or raises the tax rate. Personal consumption expenditures, it's been pretty lousy, but the last couple months have begun to pick up. We now have 2 quarters, fourth and first quarter, of a pickup in U.S. consumption expenditure, and the retail sales suggest that we're gathering momentum as we move into the second quarter of the year. Also, retail sales, again, probably one of the worst hits we've been. This is our Great Depression, but again, you know, this is all rear view mirror stuff. As we move forward now, as you have a move down, you do have a move back up. And once you look at these trends over long periods of time, once you begin to turn the corner, the upswing remains there. In the first couple months, you learn as an economist to say it's going to fall apart, it's going to fall apart, it's going to fall apart. It ain't going to fall apart. And when we look at the final graph produced by the St. Louis Fed, this is the chance where we move into a direct discussion of the U.S. consumer. A lot of it's based on sentiment and expectations. This is the Fed model of expected chance of a recession. You can see right now we've returned to very low levels. They'll continue to remain very low levels. Those tend to be able to begin to filter into consumer sentiment, in the sentiment of businesses, that we're by the worst here. It looks like we're on a sustainable and broadening recovery path. And indeed, when we look at the latest U.S. manufacturing surveys, 17 out of 19 major sectors are now in recovery mode. The recovery expanding, not contracting. Housing sector is stabilizing. We got the National Association of Housing Builders out last night, surprisingly strong. We'll get the housing starts out today. It's going to move up. These are very low hurdle rates to do better than. So you're going to pick up from now, and I think that is on course to continue. And when I talk to all my Asian friends who are wealthy, at least over the last 6 months, and I say, what do you want to invest your money in? I'm surprised by the number of people going, California property looks interesting. New York apartments, Florida. U.S. allows asset prices to fall, and that begins to clear the market. That process is underway. When I look at the corporate adjustment that tells me what's going to happen in the U.S. labor market with a lag, we see that the U.S. Corporate profits dropped from about 13% of GDP down to 9% of GDP and have been in recovery mode for the last year. And they continue to, U.S. corporates are cash flow positive. They're paying dividends. They're buying back their stock. They're beginning to see investment. Unit labor costs have dropped dramatically in the United States. Profitabilities open up. Labor productivity is very high, and hiring is beginning. If you hold demand where it is, production and hiring are going to continue to come back here. The outlooks for jobs is improving. What I've put up here is the ISM manufacturing and non-manufacturing index. Both of those are above 50 now. The momentum is up. It looks like a V to me. And even when I look at that gray line, the small businesses, those have improved dramatically. Not quite up to the zero line yet, but beginning to pick up, and that's a very important driver of growth, and policy is being orchestrated to push us in that direction. Where are my times? Okay. When I look at the consumer sentiment, and the consumer tends to anticipate the bottom of the employment market fairly well. The orange line is the consumer confidence. It has begun to pick up. It's not picking up as dramatically as in past cycles, but when it begins to pick up, generally you have within months you have a bottom of the labor market. We're beginning to see the payrolls there. I think the unemployment rate, that blue line, is going to stay high because of the aggressiveness of the corporate restructuring and the corporate adjustment to the crisis. But as people re-enter the job market, but the total employment level, where incomes are paid and drive consumption, continues to rise up here. And the consumer sentiment has been more